August has been a bit of a wild month for global share, bond, commodity and currency markets, as fears over a recession have dominated, hopes for fiscal and monetary stimulus have gathered, and headline economic data remained mixed. And that's before we get the latest Brexit and political developments here in the UK. In theory, we should have a quieter week coming up, but the news flow that is scheduled could prove informative nonetheless. Top down, investors will be looking toward the latest Conference Board US Consumer Confidence number. That is due for release on Tuesday the 27th of August. Now the July reading was 135.7, up a huge 11 points and more from June, and that took the indicator to within touching distance of last October's 18-year high. It'll be interesting to see if the financial market volatility has taken its toll on US consumer confidence. This chart suggests that the US stock market and consumer confidence seem pretty closely linked, though which leads and which follows is hard to divine. And whilst we must accept that correlation does not mean causation, it does kind of make you wonder what could happen to US consumer confidence if the stock market had a proper stumble. Now maybe that's why President Trump spends so much time talking up the stock market on Twitter and backs off on his anti-China rhetoric every time the S&P 500 index loses a bit of ground. Consumer confidence will also be in the spotlight here in the United Kingdom. Consultants GfK will release the latest UK consumer confidence figure on Friday the 30th of August. The key point here will be whether accelerating wage growth is giving the great British public a little more of the feel-good factor, or not. Now in July, the UK consumer confidence score came in at -11, a small improvement on June, but nothing to write home about in the grand scheme, although the major purchase index did improve to +4, its best score since March. Interestingly, the relationship between UK consumer confidence and the Footsie 100 or Footsie All-Share indices seems nowhere near as strong when compared to the link between consumer sentiment and the S&P 500 in America. This chart looks at the GfK data and the Footsie All-Share. Company-wise, a handful of firms are due to release an update, issue results, or host their annual general meeting. But names that may be worthy of note amidst this select grouping could include gold miner Polymetal on Tuesday the 27th of August, retailer WH Smith, oil services and equipment specialist Petrofac, and marine engineering services expert James Fisher & Sons on the 28th, another retailer McColl's, and recruitment giant Hayes on the 29th, and last but by no means least, builders merchant Grafton, which is due to release interims on Friday the 30th of August. But for me, the stock most likely to cause a big fuss in the week ahead is the only FTSE 100 firm with a scheduled update, namely Bunzl. The support services specialist is due to report its first half figures on Tuesday the 27th of August. Now Bunzl supplies the things that other firms need in order to carry out their own business, but not items that actually sell to their customers. For example, Bunzl supplies disposable coffee cups to cafes, food wrap to supermarkets, hard hats to builders, cleaning materials, and bandages and rubber gloves to hospitals. None of it's glamorous, all of it is important. And the model has worked well for many years, but unusually, Bunzl's first quarter trading statement in April didn't please everybody, and the second quarter update in June didn't go down that well either. As a result, the shares trade at 18-month lows and are actually no higher than they were in summer 2016. Bunzl revealed in those updates that sales growth on a constant currency basis had slowed to just 2% year-on-year in the first half, with underlying growth excluding acquisitions of just 1%. Now that represented a major slowdown from the 9% increase on a constant currency basis seen in 2018, when the underlying improvement was 4%. The first half also paled compared to the growth rates that Bunzl has generated pretty consistently for some time, as we can see from this graphic here. Now with this more comprehensive set of interim figures, analysts will dig deeper into the regional patterns because America has been a source of some of the first half disappointment. Management flagged lower sales in grocery and retail in particular, although do note that Bunzl won some additional grocery business in the States in Q2 last year, so the base for comparison was a good deal tougher. After a dissection of the sales mix, Analysts will then move on to 3 more sets of headline figures. The first, well, that's the operating margin. Bunzl's return on sales has been pretty consistent around the 6.5% to 7% level for the last decade or so on an adjusted basis, as we can see here, although the stated number, it's been a little bit more volatile owing to restructuring costs related to the company's acquisition programme. The second figure that people will be watching, well, that is the headline pre-tax profit figure. For 2019 as a whole, forecasts have dribbled down from 580 to around 562 million on an adjusted basis since that disappointing June update, and that implies only modest full year growth. I guess that's a fair yardstick for the first half, and at the interim stage a year ago, Bunzl's adjusted pre-tax profit figure was £258 million. Thirdly, finally, watch out for the dividend. Bunzl's increased its annual dividend every year since 1994, and analysts are expecting this streak to continue. For the whole year, consensus is looking for a 4% increase of 52.3 pence per share. So again, that rate of increase sets the benchmark for the interim payment. For comparison, by the way, last year's first half distribution was 15.2 pence per share. Thank you for watching, and I look forward to seeing you next time.